Welcome back to the series where we take on the biggest myths about life insurance and we set the record straight. So today's myth, it is one of the loudest and the laziest myths I've ever heard.
Yeah, you've probably heard it. The insurance company keeps your cash value when you pass away. You only get the death benefit. Apparently, we're all just handing over our money to some evil empire with no way to get it back. Makes for a great headline, right? But if you stop and think about it, I don't know, for like maybe 5 seconds, it all falls apart.
Exactly. And hey, if you've heard Dave Ramsey or others shout this from the rooftops, it sounds outrageous enough to believe. But today, we're pulling back the curtain and showing you why that claim doesn't even pass a common sense test.
If anything, Jonah, they should be looking at that term policy Dave is selling them if they really want to get mad about just throwing money away with essentially zero value ever coming from it. But that's besides the point. Let's tell them where this myth even comes from, Jonah.
Don't get too excited, Shawn. Video's just starting, man. Here's the real reason people think the insurance company keeps your cash value. It's because they don't understand what cash value actually is.
Right? I totally get it. If you're listening to someone constantly feeding you all of the wrong information, it only takes so long before you believe it, especially if you're not willing to fact check said person by looking into it yourself. I feel like people think that there's this big hidden pile of cash in a vault somewhere at their local insurance company's headquarters with their name written on it, and when they die, some dude in a suit is like, "Yes, I'm keeping this for a bonus check."
So let's clear it up once and for all. Cash value is not a separate bonus that you get on top of your death benefit. It's actually part of the death benefit.
It's the liquid, accessible part of your future death benefit. It's like an advance. You just get to use it while you're alive.
And when you die, the insurance company isn't pocketing the cash. That would be super shady. Instead, they pay out the full death benefit. It's just minus the cash value that you already spent from that same death benefit.
Let's make it simple, Jonah. Think about owning a house. A lot of you may own a house. You build up equity over time, right?
I see where you're going with this. I'm ready. But Shawn, when you sell the house, shouldn't you get your check for the full sale of the house and then also get a separate check for the equity that you had in the house?
No, obviously that would be crazy. You get the selling price and your equity was already baked into that number. Nobody's stealing your equity. It's just part of the deal. That's how it works. Same exact thing with life insurance.
Okay, but we have to tell them about how we set up this style of policy. See, here's where infinite banking can make this better. So unlike some generic old off-the-shelf whole life policy, when you structure your policy properly to utilize for infinite banking, your death benefit actually isn't frozen. It actually keeps growing. Literally, you may start with $1 million death benefit, but by the time you hit retirement age, it could be 2 million or higher.
So not only do you get to use the cash value now, tax-free, you're also building a bigger future payout tax-free as well.
Every time you fund the policy, you're pushing the death benefit even higher. It's literally like your future family getting upgraded seats on a flight that you already booked.
Hey Jonah, how about we give them an example of one of my own personal policies that I own? So this policy premium was $25,000 a year, but so far 6 months in, I've dumped in a total of $63,300, so that's where we'll start. If you look at the death benefit at age 33, it reads $966,506. For the first 10 years, I continued putting in my combination of base plus paid up additions. If you don't know what that is, check out some of our other videos where we break it down. We'll give you all the basics, all you need to know. But if you do the math, you'll see that after 10 years, I've injected a total of $288,300 in policy premiums. The death benefit has grown from $966,000 to $1.5 million. That's a difference of $569,000. But remember, I only put in $288,000. So really what's happening if I die is that they're not only giving my family all of the cash value back that I put in the form of my death benefit, but they're also giving them an additional $280,000 on top of that.
As you guys can see, Shawn's family wouldn't get the $306,000 he has in his cash value currently. The insurance company would pay his family out the full 1.53 million. So then the 306,000 that's already factored into the yearly increasing death benefit. So literally no argument once you understand what's going on that would lead any reasonable person to believe that they should get both. That cash value is just a representation of what Shawn had liquid access to while he was living. The equity he's built up of the future death benefit. Bottom line, Shawn, people gotta stop listening to the financial gurus who don't actually know what they're talking about. The insurance company isn't stealing or keeping cash value. It's used to build leverage while you're alive, and it's built into your death benefit payout when you pass.
It's the opposite of what they want you to believe. You're actually in full control the whole time if you understand the rules.
If you're tired of just being fed garbage myths by people who have never seen an actual policy illustration, I encourage you to use the link in the description below.
Book a call with us. We'll show you what it really looks like to build a banking system where you're in control. If you got any value out of this, don't forget to smash that like button, subscribe for more content, and drop a comment below if this video helps you understand why this myth is just that, a myth.
We'll catch you in the next one. Peace.